The stock market is doomed and I'm selling everything. That's the kind of comment I'm seeing everywhere on social media right now. And I get it. Stocks, crypto, everything's taken a sudden dive. I know a lot of you tuning in are new to investing, so I totally understand the worry. That's why today I want to address these concerns, break down the factors behind this chaos, and share my perspective on how to navigate it. I'm aiming to get this video out quickly, so it might be less polished than usual, but the information is crucial for you to stay ahead. Don't skip this one. So why is the stock market dropping? To set the scene, the S&P 500 dropped 3% recently, marking its largest one-day decline in nearly 2 years. The Dow fell 2.6%, and the NASDAQ slipped 3.4%. That's significant. My research points to 4 main reasons for this slide. Let's go through each one and see if we're facing a full-blown crisis like 2008, or if this is just a rough patch. Reason 1 is the fear of a recession. If we do hit a recession, stocks are likely to take a deeper hit. Now, it doesn't always play out this way. Like in 2020, when the S&P 500 returned 16.3% despite a recession. But that was an exception, not the rule. Typically, during a recession, people and companies spend less, earnings dip, and stock prices fall. It's a vicious cycle, and I think you can see why a recession can be a tough situation for the market. Even though we aren't technically in a recession yet, the market often reacts early at the first signs of one. So what triggered this reaction? Several data points, like the US adding only 114,000 jobs in July, lower than the 150,000 expected, and unemployment rising to 4.3%, have raised eyebrows. While these aren't disastrous numbers, they were enough to activate a recession-predicting tool called the slump rule, which has accurately forecasted every U.S. recession since World War II. In light of this, Goldman Sachs raised its recession odds from 15% to 25%. Even though the rule's creator, Claudia Sahm, doesn't believe it's right this time, it still got the market's attention. Rising unemployment isn't because people are losing jobs, but because more people are joining the workforce. Yet, as I mentioned, slowing spending is the other big factor in this cycle. Evidence of this spending slowdown can be seen in reports from companies like McDonald's and Walmart, which have said customers are spending more cautiously. Even Wayfair, a brand I personally like, I'm sitting on one of their chairs right now, reported a 25% drop in spending over the last 3 years. This all sounds worrying, but I'm not overly concerned with the slump rule in this case. Goldman Sachs isn't either. Goldman has upped its recession odds, but still thinks it's unlikely. Plus, the Federal Reserve has room to intervene if needed, which brings us to reason 2, interest rates. Take a look at this chart. Historically, when the Fed cuts interest rates from a peak, a recession usually follows, and recently they hinted at rate cuts in the near future. But this time is different. The Fed raised rates in 2022 to control inflation, a strategy that's working. Inflation has dropped significantly from its 2022 peak of 9.1%, but remains slightly above the Fed's 2% target. So this rate cut should actually be seen as a positive for investors. It signals controlled inflation, not recession, and can stimulate economic activity. On the surface, these factors might look scary, but when you dig deeper, the situation isn't as bleak as it seems. Now let's discuss reason 3, tech stocks. If you're holding top tech stocks, you probably felt this dip even harder, especially with the Magnificent Seven: Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and Nvidia. Since these 7 make up 31% of the S&P 500, when they drop, the index follows. The tech boom driven by AI enthusiasm has formed something of a bubble. Don't get me wrong, AI is valuable. It's not just a passing craze like the metaverse, but investors have overvalued current AI capabilities, and stock prices are adjusting. Even Warren Buffett's Berkshire Hathaway sold nearly half its stake in Apple recently. Bad news keeps piling up for tech too. For instance, Apple's AI preview didn't impress, and Nvidia's chip delays are impacting companies like Meta and Microsoft. Personally, I think we saw overexuberance in AI, which reminds me of the dot-com bubble in the 90s. Stocks with fast rises often fall just as quickly. Finally, reason 4 is the Japanese yen. Many traders have been exploiting a loophole with yen borrowing due to low interest rates. But recently, the Bank of Japan raised its rates, increasing the yen's value. This forced traders to sell assets to cover losses, which might be contributing to the market's decline. However, Japan has since eased up on interest rates, which has calmed some global market concerns. Now that you know the main drivers behind the decline, here's how I suggest you approach your investments. Just remember, I'm not a financial advisor. This is simply my take based on years of investing experience. First, I always follow the advice: buy when there's blood in the water. In other words, when the market's down, prices often dip irrationally low, and that's an opportunity to invest. If you do this, though, make sure you have an emergency fund covering at least 3 to 5 months of expenses. This ensures you won't need to sell your stocks at a loss if times get tough. Another strategy I rely on is dollar cost averaging, where you invest regularly as the price drops, daily, weekly, whatever works. This is especially useful if you're just starting out, as you'll likely get in at a lower price. Binance is one of my favorite platforms for beginners, and they offer $1,000 free if you use my Binance code. Diversification is key too. Spread your money across different asset types to balance risk. Stocks, bonds, even crypto if that's your style. This cushions your portfolio, so when one investment dips, others may balance it out. If you're in an S&P 500 index fund, you're already diversified, but since it's tech-heavy, consider a total U.S. stock market fund for added variety. Finally, stay focused on the long term. It's easy to hold when your portfolio is up, but when losses start appearing, it's tempting to sell. I've been there, but holding on has always worked out. Timing the market rarely ends well, and Charles Schwab's research backs this up. Selling low locks in losses. Remember, market corrections are normal and occur every 1.5 to 2 years on average. A quote I heard recently sums this up well. When the market goes up, it takes the stairs, and when it goes down, it jumps out the window. We've had a high climb, so this drop is pretty intense. If you're curious about how I pick my stocks, check out the next video, and don't forget to subscribe for more insights. See you there.